This guy found the secret to building momentum strategies. He had a PhD in finance, he was a former Marine, and wrote one of the best momentum books out there. His insights on momentum strategies are gold for systematic traders. Here are 6 key lessons you should know. I'm Manir, also known as Ghost Trades on Twitter, and I also run Unbiased Trading, an agency where we can automate or backtest your strategies. Now, number 1 is just giving a clear definition of momentum and its basic concept. Let's hear it in his own words.
What we're talking about is the most basic momentum, often called cross-sectional momentum, applied in the context of stocks. How does it work? Well, the most simple version of this is your x-axis here is time. Let's say this is 12 months. And then over here is basically your cumulative return. So if we had 2 stocks in the universe of all the stocks out there, a momentum strategy at this point in time would simply ask the question, who are the winners and who are the losers, or who has relative strength? That's what it's always been called until they changed it to being called momentum and confused everyone. And so a momentum strategy would say A is relatively stronger than B, therefore we're going to buy E or buy A and either not buy B or sell B. Now, what's interesting about relative strength strategies is, let's say that these charts were shifted down this way, and let's say stock A was down -10 and stock B was down -50, we would still consider stock A attractive. Not because it's absolutely good on a momentum basis, but it has strong relative strength, right? So
now, why does momentum actually work? If it's such a basic concept, surely it's already been traded out and there's no more edge in it.
Think about the open secret anomalies. They work for a reason. They're usually some element of risk, and there may be a mispricing in there, but it's very, very expensive and painful to try to arbitrage it away. So a lot of capital, unless it's got a 20-year horizon, is kind of crazy, is not going to stick to it. And the bottom line is, you can backtest till your brain explodes, but if you can't identify the pain, there ain't no gain, right? There's got to be some implicit pain in order to get gain. That's how market equilibriums work in a competitive marketplace. Now, that pain may not necessarily be something that drops out of a macro equilibrium factor model that's based on, returns to be somehow related to consumption or whatever. It may be irrational pain, like you hate getting fired by your investors, and there's career risk, but that might be a price risk premium as well. And that could be associated with the value or a momentum, right?
Now, I think he explains this wonderfully. Personally, I think a lot of strategies only work if there is a pain to them. At the end of the day, most strategies, well, pretty much all strategies, will always have risk on some sort of level. And he's saying here that to arbitrage out momentum, there's just too much pain involved where it wouldn't really make it worth someone's day or while to invest that much capital to completely arbitrage out momentum. End of day, like he was saying, even people that run hedge funds and things like that will have to answer to the bosses or have to answer to their investors and shareholders. A big problem when people put money in a hedge fund, for example, is they can pull out their money if they feel like if there's too much risk being played. Now, that is, put it simply, now there are most of the time minimum holding times and things like that when you do invest into hedge funds. So this is just a simple example, but it still goes around to the point that there simply is no pain with no gain. There's always going to be a pain of why your strategy is working. And I think Robot James, he is a crypto trader and also he's got an amazing blog as well and also a pretty good Twitter feed. He explains a lot of this around a lot of the strategies where, to end of day, for you to make your money, you have to take a pain or a risk that someone else is not willing to take. And you're taking that for that premium or for that chance of that premium, for example. So when I try to make a strategy, most of the time I'm thinking about what risk am I taking on that other people are not happy to take on, for example. Now, to give another simple example, I won't go into the full details of everything that goes into small caps, but personally in small caps, the reason, in my opinion, it hasn't been fully eroded is that there's a lot of risk that you cannot handle in small caps. For example, if you're shorting small caps, you can get trapped by holds. You have terrible, different like T2 holds, which are news holds. Those sort of things have unprecedented risk, meaning that it could just be one trade out of 1,000 that you get stuck in a news hold and that wipes a lot of your account, depending on how aggressive you are with sizing into that particular trade. So that is, in my personal opinion, small caps can have more of a simpler statistical edge, and it's quite easy to see when you have that data, but nevertheless, actually trading that edge is fundamentally very risky compared to something, maybe if we compare it to futures, where you're never going to get catched in a T2 hold, for example. Now, momentum strategies actually work best when they are constrained.
Reality, and I'll move over here, is just the cold hard facts that the returns generated from momentum are built with portfolios that will be capacity constrained. So let me orient you to this chart. What this is this is compound annual growth rates over the last 40 or 50 years where it's the same exact momentum strategy. You sort stocks relative strength on 212 momentum. Just think of the last 12-month returns. You have 1,000 securities. If you want to own the top 10%, you'd own the top 100 based on who's got the highest past 12-month return, right? But that core signal can be varied on portfolio construction. We could buy the top 500 securities based on momentum, or we could buy the top 50 on momentum, right? Like, so we could go low concentrated momentum, high concentrated momentum. The other way we can vary this portfolio is how fast we turn it over. So we could, on January 1, do the momentum sort, and then wait till next January, do the momentum sort, and rebalance the portfolio that way. Or we could go high frequency, up here where it says 1, and do it every single month, right? And what you notice is there's pretty much a direct relationship between returns and how concentrated and how high intense the turnover is with momentum. I.e., it's mechanically capacity constrained, because fewer securities means less capacity. It's a lot easier to put $100 in dividend around 500 stocks as opposed to 50, because you got to put too much in each one. And then obviously turnover is a capacity constraint, because I got to trade a lot more doing a monthly rebalance versus an annual rebalance, right? And so the cold hard facts is if you don't do momentum in a way that has capacity constraints, you don't earn the returns.
Now, what he's saying here, just put simply, is that the more concentrated your portfolio is for momentum into a group of stocks, the higher return is going to be, and the faster you're doing a turnover for those, so meaning switching out and rebalancing that portfolio of momentum stocks, the better or greater your returns are going to be. But by doing that exact thing, you're going to be constrained on capacity, because there isn't as many stocks you can split your capital over. This is obviously more directed at if you're trading, billions or multi-millions, for example, of capital. If you only had 50 stocks where you had to put billions into, that's a lot of a more difficult task compared to splitting that over with 500 stocks, for example. So end of day, what this kind of just means is when you're designing a momentum strategy, if you aren't too worried about being capital constrained because you just maybe don't have that much capital, it is better to be concentrated, and that's where you're going to get the higher amount of returns with momentum. But always keep in mind that does often mean more volatility and standard deviation from your returns compared to being more diverse across maybe 500 stocks, for example. Now, if you need a team of quant developers who can properly backtest and automate your strategies, such as a momentum strategy on Interactive Brokers, visit the link down in the description and you can book a call with me and we can discuss your idea, and I can give you an idea of how that could be possible. Now, 4, simplicity versus complexity.
Which is weird. Right, even though I can backtest it and on paper, like, okay, it looks like you shift between value and momentum, you get like an extra point on your CAGRs and whatever. But I just think, well, I'm giving up the structural, probably out of sample, like economically driven, cooling benefit. And that's worth a lot to me. And I can't really prove it per se with the data, because you can data mine out and say, well, I should be a factor timer. But it's one of those things where just going back to first principles, I lean towards simple and kind of crappy, but robust versus complex, high chance optimization, whiz banging yourself to death.
Now, this is a lesson I think people that have been doing algorithmic strategies for a while will finally understand, and newer people to the space definitely do. It takes a while to understand this principle because it goes against what your brain, I think, inherently wants. Your brain wants a really amazing backtest that shows you incredible results, and that is going to be the strategy you take live. Ultimately, it takes you a good amount of kickings to realize that the more you optimize your strategies, the more complexity you add into them, more than likely they're just not going to work when you actually put them onto live market or out of sample data, for example. Now, I really like what he says there is that he prefers a crappy system, but it's robust. And I think this is such a good motto to go by when you're building your strategies. Yes, you could always get way more returns in a backtest. You can always improve performance in a backtest. However, being comfortable with knowing that, okay, these maybe aren't the best returns. They're still decent, it's still worth your risk, for example. But I'm going to use this version of the strategy compared to optimizing it to Kingdom Come and then try and get, 1,000x return every single year. That is never going to really work on a live market, or I would say it's, 0.00 sort of 1% possibility that it's actually going to work. Another part I want to focus on here is that he talks about focusing on the principles of that strategy. And I think Pedma, another amazing crypto trader that's also on Twitter, he talks about this and was recently tweeting about this, how simplicity comes from smart choices. Simplicity sounds super simple, and when I say, simplicity versus complexity, you may be thinking, oh, I should just be doing a moving average crossover, right? Sort of, yes, but with that simplicity, you need to be smart with your choices, and being smart with your choices I think, at least in my experience, you really need to understand the different strategy types and their extremes, right? So you really need to understand what would be the best mean reversion strategy by the principles of a mean reversion strategy, what would be the best trend following strategy by the principles of a trend following strategy and its normal characteristics. An easy example, right, is trend following is always going to have time periods of longer stagnation compared to a mean reversion strategy. The reason for this is a trend following strategy is going to take a lot of smaller losses, and it will have one loss that is super outsized and makes up those previous small losses, but that's going to mean it's going to be a low win rate. That's going to mean it'll have longer drawdowns, deeper drawdowns. It's also going to mean that you're going to be higher variance if you miss a trade, for example, all those sort of things, compared to a mean reversion strategy, which is higher win rate. You're not making as big of returns on each individual trade. You're often also taking maybe sometimes profits below even 1R risk. That really depends on the mean reversion strategy, but that's just kind of the example I'm giving. So understanding those principles of the strategy and trying to stick to those principles and only enhance those principles is normally where I found the most edge compared to adding a million different filters to, filter out everything. This also goes into the conversation of like, don't try and build one strategy that matches all of those principles. Most of the time, what you're going to lead to is a strategy just no longer works. From my experience anyway, obviously you can do your own testing, but trying to combine a mean reversion and a trend following strategy together into one signal can be very difficult and often never works. For me, it's always better to have a mean reversion strategy and a trend following strategy, have those in a portfolio, and those negate each other's risks. Now, 5 is momentum tends to work well in combination with value investing.
Tinker with like factors and if you let's say you're a value momentum person like we are, like I always tell people, listen, value's got its own religion, momentum's got its own religion, and they're structurally different. That's why the yin and yang with each other. And that's a known bird in the bush, right? So you could just hold both of them and get the known diversification benefit, pretty valuable. Or you could start dicking with it and say, well, let's shift our momentum because of this macro regime or whatever whiz-bang model you got. We're going to shift the momentum, shift the value or whatever. The problem is that's fine, and you can back test it and show that it might work, but now you're structurally giving up the awesome bird in the bush you had, which is just combining the two things, right? So it's one of these things where I'm kind of moving a fortune.
Now, pretty much here is what I was just talking about previously, is being diversification with those different strategy types instead of trying to combine them all into one. And it can work really well. You can diversify and negate other risks of different strategies, and that will smooth out your equity curve and your returns, leading to, probably lower drawdowns and not necessarily higher returns, but it will definitely be more risk-adjusted return. Now, 6 is you can't fully eliminate drawdowns. You will only ruin the alpha of momentum.
Let's look at the drawdowns on this God portfolio and the S&P. And it's remarkable. Like, this was the most surprising thing ever. Like, the drawdowns are basically the same. He recoups way faster, right? So, which is good, but he still loses, like in the Great Depression, 75%, where S&P is like whatever, 85, right? So the main point is risk just cannot be destroyed. Even with perfect foresight, if you own beta, you own any equity risk, even if you know exactly who the winners are, this risk just cannot be destroyed. It's just a fact, and it's remarkable, and it just highlights over and over again that to the extent that someone is pitching you something that says, hey, I'm so smart, I make a lot of returns and no risk, because we know these sort of facts, I'm like, that's impossible. Like, even I know with perfect foresight the best trader on the planet, and I know he gets his face ripped off sometimes. So you're telling me you're smarter than God, right? It just can't be the case.
I personally love this little clip where it just really hones down the point that if you're going to have excess returns, you're going to have a risk. There's no way you're getting excess returns without risk. Even if you're just trading the underlying, obviously, beta, then you're always going to have risk anyway in itself with that. So don't try and remove all risk. I think that is a fool's errand. It's totally okay to try and reduce your drawdowns, but to reduce it to such a significant factor, that's most likely just not going to happen. I think for me personally, from my experience, the best way around doing that is by adding in diversification, building a portfolio of strategies that then can, ultimately reduce the drawdown of the whole portfolio compared to the individual strategy itself. And what he was saying here was very interesting as well, that like you can have a momentum strategy, right? It actually has the same drawdown or very similar to S&P 500, for example, like as a beta underlying, but it just recovers quicker. And that is another beneficial factor of a strategy. Yes, it may have a similar steep amount of drawdown, but if it recovers in half the time, you have more compounding during that time because you've recovered so much of your equity already. So that can be a beneficial part of a strategy, even though it doesn't necessarily mean, oh, I have less, max drawdown. Now, if you want to learn even more from Wesley Gray, be sure to read his book, Quantitative Momentum. It's a great book, pretty good read. It has some good examples as well. I will say that, personally, Wesley Gray's performance on his fund hasn't been the greatest. Personally, for me, I don't mind too much about that. I try and get inspiration and creativity from anyone that talks, especially if they're providing really good examples and backtest results as well. So it's always interesting for me, nevertheless. But if you are just looking for a copy and paste strategy, then yeah, probably copying one of his strategies isn't going to work very well. But if you just want inspiration and creativity that can lead to building better strategies or new techniques, for example, then I personally do think the book is a great read, especially if you have some spare time. Now, if you find this type of content valuable and want more every single week, be sure to follow me on Twitter at GhostOpTrades, or you can subscribe here and I post a video about once a week, give or take, and try and provide as much value as possible. Apart from that, have a great rest of your day.